Learning objective 3 is we're looking at capitalization and depreciation. Specifically, the example we use, by far the most common, is property, plant, and equipment. What we do is we buy a piece of equipment. Well, here we have an asset purchase, but it's now being used by the company. So we have to find a way to spread that cost over the period of time in which it benefits the company. That is called depreciation. Now, there are different methods for depreciation, many more than two, but in this particular module, we're going to use two of the more common ones. One is straight line, and the other is double declining balance. Straight line is, as name implies, straight line, same amount every year. Double declining balance is one of the ones we call accelerated, which means we take a bigger depreciation up front in year 1, and then it tapers off in years 2, 3, 4, and 5. In total, we're going to depreciate the same amount. We want to accelerate it because the value drop is more pronounced in the early years. The best example of this is you buy a brand new car and you drive it around the block and you drive it right back to the dealership and say, okay, I want to sell you this car back. That is going to depreciate by a lot of money. The observation is that assets tend not to have a steady year by year identical drop in value, that the drop in value early on is greater than the drop later on. So that's general logic of having an accelerated depreciation method like double declining balance. Then we'll look at what is the tax impact of these choices. When we look at capitalization, we buy it and it's called a CapEx, otherwise known as capital expenditure. And instead of going to the income statement, it goes to the balance sheet. And now we will then spread that, allocate the costs over the time in which that asset benefits the company. And that's what depreciation really is. We need three assumptions to get at the calculation for depreciation. The first is a useful life. Is this truck going to last us 3 years or 10 years or something in the middle? Salvage value, when we're done with it, can we sell it to someone else even in its used state? That is the salvage value. And third is what method do we use? As mentioned, straight line or other method. Straight line method is when we look at something like we buy a piece of equipment, like a piece of machinery, and the cost of $100,000 is $10,000 salvage, which means at the end of its useful life to us, we can sell it to somebody else, either as a used machine or as scrap metal for $10,000. And the life of this for us is 5 years. So when we use the straight line method, we look at two factors. One is what is the base? Like what is the total amount we're going to depreciate? Notice in this case, it's never going to go to zero. It's going to go for $100,000 down to 10. So we want to show that amount being charged over the useful life of the machine. Base is 100 minus the salvage value of 10 or 90. Okay, next is how much do we charge? Well, under straight line, it's easy. How many years? The number of years is 5, so 20%. For each of the next 5 years, we're going to charge 20% of the depreciable base of 90 per year, so 18,000 per year. Double declining is trickier because it says, well, take what you would have, but double it. In this particular case, we're going to take the depreciation rate of 1 divided by 5, or 20%, and double it to be 40%. Now, of course, you can't charge 40% every year because you don't, by 3 years, you're going to charge more than you paid for the equipment in the first place. So it's 40% of what? It's 40% of the declining balance. That's why it's the name. Double means double the straight line rate. Declining balance means it's the rate times the declining balance. So that sounds all kind of like a lot of words, so it's best to show it in example because it's not hard once you see it. Let's try it out. Let's use the same scenario. $100,000 for the machine, a salvage value of 10, and a 5-year life. And we'll use straight line, and then we'll move to double declining balance and compare them. The questions that we're going to answer for each, one is what's the depreciation expense each year? Next is what is the net book value at the end of each year? Net book value is your cost minus all the depreciation you ever took. So that's the remaining value, if you will, in the asset for you. Third is show the accounting entry for one of the years, just so you can see how depreciation is recorded. And then look at how do we show this to investors. Okay, so this is a spreadsheet, and I've just copied and pasted the facts so we can see it side by side. So I'm going to put it in Excel cells so I can use it in the formula. The original cost is 100. The salvage value is 10. Useful life is 5. The rate is equal to 1 divided by the useful life, or 5. This is 0.2, otherwise known as 20%. Right? So that's what we saw before. So how do we put that into action? The beginning book value when we first bought this machine is what? It's 100. So let's put that here. The depreciation expense for the year is, the depreciable base is open parens, the original cost minus the salvage value divided by 5, which is the same as multiplying times 0.2. So it's 18, and then the accumulated depreciation is the first year, is the same 18. Ending book value is the beginning book value minus this year's depreciation. So it's 82. Beginning book value for next year is the 82. Depreciation expense is the same. Straight line means it's the same. In fact, we can copy that now all the way. And so we're going to have 1, 2, 3, 4, 5 years, and the sum is 90, which makes sense because we want to have 90, so we have a leftover 10. So let's just carry this out. Accumulated depreciation is last year's plus this year's, and so the book value is beginning minus this year's depreciation. We can just copy this formula, copy, and we end up with this. So this year we put 18, accumulated goes up, the book value drops, and the final year we had 28 minus 18, accumulated is 90, and our book value is 10, which is the salvage value. The totals, I'm just going to say that we started with 100, we depreciated 90, the accumulated depreciation now is 90, and the net book value is 10. All right, so that's how it lays out. Now, how do we record that? The key number is right here, right? What is our depreciation? 18, all right? We had a straight line, we have PP&E of 100, and we start the year with 0, and the expense for this year is a minus 18. The entry is, this is a minus number because it offsets this 100, right? It makes it go down, so that's why it's opposite sign. And on the expense side, depreciation expense, and that's also minus 18. So we're balanced, right? So we have negative 18 on the asset and negative 18 on the expense, which has a retained earnings going down by 18,000. Each year, we're going to be adding one more of these rows of expenses. But what's different is that the accumulated keeps growing. So at the end of this year, we would have 100 minus 18. Then the next year, when we start the year, we'll have 100, but we'll start the year with 18. And let me just do this. I'll just illustrate that by... So that's still the same, but we'll start the year with 18. And so if we have another negative 18 here, our end of year for that year is going to be beginning year balance plus 18. So you see creeping up from 0 to negative 18 to negative 36. All right, so that's how depreciation works. Notice we didn't touch the asset at all because that machine cost us $100 and we're just leaving that be. The action is in the accumulated depreciation and the depreciation expense for each of the years.